All us hosers.
Listen, it
Oh,
is a real joy to have the nicest man in markets, Kevin Muir, join us on Benny and the Squirrel. And in his honor, we obviously had to play the hip. Um, Listen, Kev, your tagline is all I bring to the party is 25 years of mistakes. It's been at least 35, so let's
I
add
know
that one.
that's already a mistake, right? Like it's right there in the title. I bring one more mistake, which is that it's 35.
Yeah, 35 years in the markets. Everyone knows who you are. You don't really need an introduction, but we're thrilled to have you on, Kev. And I guess where we want to start, we're going to go deep macro later, but I wanted to start. I wanted to start in Canada,
Okay.
and really,
Get
really
rid of
sort of
all
put
your just get everyone to hit delete right now and to like stop it.
No, it was a great call. I'm going to put a slide up on the stage because um, you did the Office meme around Poilievre and Carney back in March, which I thought was a fantastic call, and it was enough to get me long the Canadian energy stocks that I'd been eyeing for a while. So talk everybody through that call because I thought it was fantastic.
Yeah, so if you remember our previous prime minister, Justin Trudeau, he's universally hated, especially in Canada and especially amongst the kind of typical right wing finance community. And they hate the liberals, and they were very excited about getting this new fellow, Pierre Poilievre. Was all set to win the election, and it was going to be this dramatic shift in terms of where Canada was headed. And then Trump came, and Trump really threw a wrench in it for Pierre Poilievre because he was running on kind of a negative platform in terms of what Canada, and it was very much the same kind of rhetoric that you heard out of Trump. And then when Trump attacked Canada and started talking about 51st state and all that stuff, Canadians really got their backed up. It was very, very emotional. And a lot of my right wing friends were like, oh, geez, now we're going to elect this liberal guy, and it's going to be the same thing as the past decade plus of Justin Trudeau, who they famously kind of just always remind me he's has no real credentials, and he was previously a drama school teacher, like a high school drama teacher. And I kept saying to them, I'm like, listen, if you actually stop to think about what you're comparing here, like Mark Carney is like a former like central banker. He worked at Goldman Sachs. His last job was at Brookfield. And you're trying to tell me that this guy is going to be like the drama school teacher that you keep comparing it to. And I kept saying, it's the same guy. Like that, it doesn't matter who wins. Canada is going to shift to a pro business environment, whether it was whether it was Pierre Poilievre or whether it was Mark Carney. People didn't want to hear that. As I said, Canadians were just there, like the business community were so sick of the liberals and so frustrated with them that they kept telling me, no, he's married to a woman who's a greenie. They're not going to do any pipelines and stuff. And I'm like, listen, I love my wife dearly, but she doesn't tell me what to trade and what to do. I don't know about you guys, but I make up my own mind. I don't listen to my wife. And sure enough, it ended up being that when you look at Mark Carney, he won obviously the election. He almost won a majority, which was it was unheard of if you said that kind of 6 months ago or a few months before the election. He almost won a majority, and his lurch to the right has been probably even stronger than Pierre Poilievre's would have been. It's been all pro business. It's been unbelievably great. Like I went to London and I was chatting with some folks, and these were guys that knew him from when he was back at the central bank of the Bank of England, and they were so excited. They were literally just chomping at the bit to buy Canada because they looked at this leader and they said, this is probably the most capable leader in the G7. And I found Canadians were just so, sick of the liberals that they let their politics get in the way of their trading. And I'm still fighting people about this, and they're trying to tell me, that he's going to revert back. And you look what he's done. He's fired the climate minister, or they agreed to go the other way. He's gone and done a pipeline. And all of the pushback I get is he hasn't done enough. And I'm like, if he did any more and went any faster, I'd be concerned he wasn't doing a proper job. So to me, he's been the adult in the room that has just put his nose down and is getting things done. I feel like Canada, for the first time in many, many years, maybe decades, is on the best footing that we've ever had. I'm excited about our chances and our, where we're headed. And if you think about this new environment with commodities going, gangbusters, it's a great investment opportunity in Canada.
Yeah, where do you sort of score the Canadian energy stocks now? I mean, they've had a
Oh, I
great
still love them. I think they've just started. Yeah. They're some of the best run companies. There are, in terms of our reserve life, it's not like the shale that's about to, drop off a cliff. Like, these are long life assets, with a government that's stable, that's going around the world and not, making headlines, but quietly saying, listen, we are the stable partner you need. I always joke, though, Rupert, that it kind of makes me mad because when I think about how the world has gone over the last decade, if you think about who was selling most of the energy out there, it was like Russia and Saudi Arabia. And my joke is like, we don't invade neighboring countries and we let our women drive. Now, I know that Saudi Arabia, they let their women drive now, but my point is that we, instead of sitting there and trying to curtail the amount of energy that we were producing, we should have said, no, we are a responsible supplier of the world's energy that we need. And so it's made me mad. I feel like that finally Carney has gotten on this bandwagon. We are going to go around, quietly sell this. He doesn't make a lot of headlines, but that's not what you want. You don't want headlines. You want someone that's just getting the job done. And I feel like that's Carney.
I mean,
fantastic.
Like, Kev, when you were on my old podcast on Liberation Day, which was kind of an amazing thing, it reminded me of Louis Vincent Gav, who will be on the show in a month, when he was on the Macro Voices podcast and oil went to negative 47. It's kind of fun to like not be fully in the market while you have to pay attention. You were talking about some of these things, the dynamics, and it's been very easy to be negative on Canada for a while, right? And I just looked at the chart, and I had a guy who's at a very big asset manager, like one of the biggest, today pitched me on long CAD. And he knows that I like the dollar. So he's like, what, do you have any updated views on the dollar? And I just look at the chart. I was like, looks okay. And now you're telling me you're, as a Canadian and as a macro investor, and like, it sounds okay. It sounds like, so it's early days? Is this like 2002, 2001, when buying a condo in Whistler, Canada was actually the best play on oil there was over that cycle?
So I'm not going to get it bullish on the real estate because we have blown a big bubble there and we do have a lot of problems that we need to go through. So I'm not going to sit here and just kind of pretend that we don't have issues. We have issues. We have to rebalance our economy. It is going to be a difficult slog. But if you're taking a longer term view, if you're thinking about things, past the next quarter and you're trying to deploy capital for a longer term basis, this is a great country to be in terms of what we have and the stability of our leadership. So I look at this, and not only that, like in terms of Canada versus the US, I suspect we've seen the worst, and that we're going to look back and, we'll come up with a deal. We'll figure things out. It's not in Trump's interest in the long run to go and actually punish us. Look, let's take aluminum. Like he's put this tariff on aluminum, but the reality is that you're not going to go make any more aluminum smelters in the US. So when you start, putting some big, huge tariff on the Canadian aluminum, all you're doing is shooting yourself in the foot. And I think that eventually, once the emotions, tamper down, that Trump will realize it and that we'll go back to being partners. Now, having said that, I will say that a lot of my American friends don't appreciate the lasting damage that has been done in terms of with our relationship. And I actually view it as a Canadian as a little bit of a good thing, because we used to sell you oil at this huge discount because we were too stupid to have a pipeline out to the coast and actually ship it to other markets. So what Trump has done is taken a relationship where you guys were in essence just coming and picking up our minerals and our resources at dirt cheap prices and taught us to go out and sell it to the rest of the world at much better prices. So I in a lot of ways, I'm thankful for it, because I've been arguing that we should have a pipeline and we should be selling it to China forever. And we always used to, shake our heads at the stupidity at selling it to a discount and being landlocked to you guys. And now you forced us to go deal with it. It's kind of like, when they say in business that you should never, force your customers to go out and see your competition. Like if you have a captive customer, the worst thing you want to do is make them mad, so they go start looking at different alternatives. And that's how I feel about it. So when I think about Canada, I think it's a terrific investment. And in terms of the big macro, I'll just bring back this to macro. So when Trump was there, or when Biden was there, you guys are running deficits to GDP of 7%. Right. And everyone, when I would talk to people and I say, listen, America is running deficits to GDP. What do you think Canada's running? And they'll be like, oh, those socialists, and they have terrible finances. They must be running 10% deficits to GDP. No, we were running 2% or 2.5%. Europe was running 2.5%. Japan was running 2 or whatever. The rest of the world was running very much more conservative policies. And that was actually hampering us. We were having limited amount of growth because we weren't spending enough. And what Trump has done is he's forced the rest of the world, rightly or wrongly, and it doesn't even matter, because of us as investment, people, we shouldn't be judging what we want to happen. We should be judging what is happening and what that means for markets. And rightfully or wrongfully, Trump has gone and made the rest of the world start spending, and that has changed the dynamics greatly. Like, look at Germany. Germany used to run a 0.35% the deficit to GDP. Now all of a sudden they're spending. So there's other places that are now growing because the rest of the world was lacking that fiscal, spending. And there's lots of consequences to that. I think we're going to have more inflation. It's going to come quicker. There's a problem maybe with you guys funding your deficit because there's no longer as much other people are using capital. Like, for example, in Canada, we're bringing home some money so that we can build our pipelines, so that we can invest in ourselves. So ultimately, this is actually, I feel like, shooting yourselves in the foot, because I think you had the great deal, and now you're kind of teaching us to go, do it on our own. And I feel like it's great for Canada, and it's good. And maybe you guys will say this is better for us as well. And if that's the case, so be it.
But maybe what I would say to you is, maybe it's just peaked out, right? There's only so much capacity for global capital to flow to the US, to flow to Silicon Valley, to flow to financial assets, to flow, and America's clearly underinvested in industry because of debt-fueled consumption, right? And like,
I don't disagree. Yeah, I don't disagree. That's why I'm saying it might be a good thing all around.
Yeah, exactly.
Having said that, though, I just don't think that people have thought through the consequences of what that means and what will change. And so far, it's not a big deal, because so far you've replaced all your like, the AI is still attracting capital. And I know we're going to talk about the US dollar, but the AI money keeps flowing in. But eventually you will get into a situation where the dollar will get into trouble. And when that happens, it'll be interesting to see how what happens and how people react.
Yeah. And, I would actually say that when we go back to the GFC, the dollar was completely on its ass. But in Q3 of 2008, US was producing like 5.7 million barrels a day. Now we're at 14 plus as the number one. That was what actually saved the dollar. Like, I know everybody hates oil and gas, but the shale revolution is actually what saved America and what saved the dollar. And so it's interesting you say, oh, well, EURs and fracking could roll. And I agree with that. I think there is a energy bull case coming up, but that would be where I would get on board. And so when we talk about Canada, do you think that they'll do an LNG port? Like, why is that?
Yeah, I think we already got one going. We're making, there's a whole bunch of things like that. That everything is just being like, business is is ready to go, like for business. In essence, it was. I saw something the other day, a clip from the CBC in terms of Nova Scotia. Nova Scotia had previously not allowed any mines and stuff, and now all of a sudden they're doing, lithium mines and they're whatever it is. We understand that because it's a threat to our existence. Listen, if we don't smarten up and figure out how to deal with this, like we won't exist. So it's not like should we, could we? It's like we have to. And that's the point that I think that folks don't understand, is that we realize that this is an existential threat to who we are. And we need to get our economy going in terms of making ourselves self-sufficient and more dynamic. And there's a million different things. Like I just look at what he's doing in terms of the banks. He's encouraging banks to lend to business. Like, so we have a problem of too much credit in real estate. So we're obviously going to have to go through a little bit of a correction there. And who knows if they're going to be able to skate that on side without any real problems. But at the same time, we can't let that stop us from going out and making sure that we're making loans to businesses and things like that. So he's loosening the standards upon which and trying to encourage those businesses. Like everything he is doing is the stuff that a previous, like a right-wing prime minister would do. It is all business friendly. I tell all my right-wing friends, I said, listen, if this guy had run for the Conservatives or the whatever they're called now, you guys would have loved him. You just hate him because he's a liberal. And I said, forget about, put aside your party politics. Just look at the policies. And when you look at the policies, they are all business friendly. They are all terrific. And I'm not trying to say that we don't have problems. We do have problems. It is going to be difficult to do our real estate. We've made a mess in so many ways. We let our immigration get out of control. It's not like I'm naive and blind to our problems. It's just that I don't know what they want from this guy, because to me, he's doing absolutely everything that's correct. And when I go talk to international investors, all the big smart money are like quietly going and investing in them. It just doesn't make enough into it.
So minor digression here, Kev. So last Friday, we had that massive sell-off in Brazilian assets because it looked like Bolsonaro's son was going to run for president. Yeah. I had to say, it just reminded me of earlier the year in Canada. I mean, I think Brazilian risk assets were pricing the possibility of a White House endorsement of Bolsonaro Jr. I mean, it was completely wild. Anyway, total digression. I think we should get on to your thoughts on the dollar and then.
Well, yeah. Let me put this on just to give Kevin a little credence. Let's look at this real quick. That is the 5-year Canadian dollar, which has been very easy to be a hater on the Canadian dollar for a while, popping its head up there, huh? And as a guy who loves down and to the right charts, as Rupert knows, and now you know. It kind of looks like Schlumberger's chart, which I gave out to our listeners on Sunday.
What can I say?
And Benny, first of all, Benny, you're going to get all the real currency traders are going to be mad that you put it on the reciprocal, and they're going to be confused.
Yeah, I actually did that intentionally.
Because you wanted it to show down to the right.
Yeah, exactly.
The thing about this is that I was actually a huge CAD bear. Like for like 2 years.
Great strategy. Look at that.
Yeah, and I was really bearish. And what happened was that I felt like there was a change in government and a change in attitude, and I covered it and it went long. And I don't usually kind of cover something and then go the other way, but I really feel like that this is an opportunity. I don't. It's not like I love the Canadian dollar. That wasn't my trade, by the way. My trade was to go buy the resource companies that were going to do well. It was going to be a basket of energy names, a basket of mining names, a basket of the infrastructure names. It was all those kind of things, like the kind of things that, hurt when you drop them on your foot, as Dennis Gartman used to say. That's what I was excited about and was like pushing. And those have done very well.
Yeah. And I guess when I said buying a condo in Whistler, it wasn't actually because of the condo. It's I figured out that was actually the best play on oil, because Canadian dollar was at like 60 cents, and then oil was on its ass, and then basically everything ripped, and then you got the Canadian dollar to double, you got oil to double, and then it ended up being like a 50 bagger or 40 bagger or something, you know.
Now, having said that, Whistler condos are almost on the highs, and it's all crypto money, so you don't want to own that. And by the way,
I'm just using
and
that
also North American skiing's getting ruined, right?
Yeah. Oh, yeah. And by the way, during the global financial crisis, like everyone I know went and bought a Florida condo, because if you remember back, our dollar was par, and you guys were having all this problem with your real estate, and ours was actually hanging in there. So all my buddies like own like Florida real estate, and it was all during that time. So maybe you're right. Maybe this is going to be a time to own it, Canadian real estate. I just think that we have blown a bubble in real estate for the past decade. Because don't forget, you guys corrected and we just kept going.
100%.
Right?
And I was agreeing with you. I was just saying that was like the derivative play. And now if you think, hey, the natural resources can come in, you get some money to come home, and then you can get the currency to work and the local stock to work. And that's usually the great, if you can get the double, like that's why everybody loves US stocks, because you've gotten paid in both sides, right? And the last time we spoke, you know, you and Rupert, to be fair, I had Rupert on my old podcast in January, and he was dollar bear, and which was a fantastic, both of you guys were right this year. But everyone was getting paid both sides and not hedged, right? So if your assets going up and your FX is going up, who's not going to love that until, you know, eventually it doesn't work anymore? That's all.
Can I tell a quick story about that? Because I think this is a really interesting point. When you look over the last decade, and just imagine you're a European pension fund manager, and you were thinking about buying stocks, and you were looking at your stocks in Europe, and we're sitting there and they're starving the whole economy of fiscal stimulus. Rates are negative. Nothing's going on. There's no growth. Meanwhile, in the US, we have this huge roaring bull market. We have all sorts of deficit stimulus. And it's not only that, there's like fiscal out the yin yang. But one of the beautiful things about them owning the US stocks was that they own them in US dollar terms. And when the crap really hit the fan, like if we had a risk off event, typically the US dollar would go up. So it was actually a volatility dampening, relationship for the European pension fund manager, right? They could buy more US stocks because in euro terms, when it declined, it would actually decline less because of that negative correlation in times of risk off. What I think
that was embedded into their whole asset. And look, I'll show you.
Listen, what's funny about it is I was chatting with someone, and I said I've never seen someone who's actually admitted this. And then I was out for dinner, and I was like, and then someone actually said that. He said, "Oh yeah," and then I can buy more U.S. stocks because when the U.S. stocks go down, the euro goes down as well, and the U.S. dollar is going up. And I'm like, "Oh, I finally met one in the wild." Right. What's interesting about this?
Very true. It's very true down here in Australia.
Yeah.
The super funds. They view the Aussie dollar as an equity risk, right? Yeah. So they don't hedge at all.
And so what I think is super interesting is that Liberation Day, for the first time in like forever, decades, we had a whole bunch of correlations not work. Like, think about it. You had U.S. stocks going down. You had U.S. bonds going down. So that traditional relationship, negative relationship, wasn't holding up. And you had the U.S. dollar going down. It was
as we like to say.
Yeah, it was the worst of all worlds. And ultimately, I actually think that that's way more of a danger and underplayed in terms of going forward. Like, I think what saved you, because the US dollar has gone down, and you were kind to say that we've got that call right. And we did get it right at the beginning of the year, but let's face it, it's gone nowhere for 6 months. Right?
So let me bring this up while we talk right here. Okay. This is the put skew versus the spot of the euro. And I think what really happened was a ton of dollars flew out of the country in anticipation of the tariffs, right? So huge amount of dollars flew internationally. People got caught off guard by that. And then if you see that put skew, which is the green, people are like, oh my God. And you said it, because literally we were on the podcast together the day of Liberation. They're like, oh my God, I'm caught off sides as a carry pig. I need to hedge myself. And that's exactly what happened. So it wasn't so much people leaving dollar assets as they realized I actually have to hedge my currency. I can't get paid two ways, basically.
Yes, I don't think that they've hedged it all. I think they've hedged some, and it's increased.
Well, this
But
would tell you
Eddie, I
differently,
would
right?
say that is the largest, biggest whale of a trade out there is the overweight of U.S. assets among international investors. It is like it in 1 year is not going to fix it, because the reality is that it's been a decade. And I'll tell you, I was out afterwards with people in like a couple months later, and I asked them, how much have you hedged? And a lot of them have said, no, I haven't hedged anything. It hasn't paid to hedge for the past decade. So I think that there's still way, way, way more hedging to come.
Yeah, so this can go below, like we could go into a call skew situation, right? And so I'm just saying that no one was hedging, and then you can just look at the price of a 10 delta put, 6-month 10 delta put relative to at the money,
Yeah.
and it went from this regime where no one did it. Then some people were like, I got to do it. Then the hedges stopped working at the end of June, like you said before,
Yep.
and then we had a little give back, and now people are like questioning it again. They're like, is it
100%. I agree that there's a lot of I don't think that the long-term money is questioning it. I think that they have a plan. I think that they will do it. I think that they'll look at the numbers and they'll realize that the correlations aren't what they previously were, and that bit by bit, investment committee by investment committee, they will start to do it and increase their hedges. But I think that the problem, what I wanted to say was, why did the US dollar stop going down in June, like in the summer? Like, why have we not, like, we've been treading water? Why is that?
Don't say European.
I would argue that the hedges got pulled off, and like
I completely disagree. I think long-term money is still selling, and they just started to peel it out, and maybe they've stopped selling. I would contend that the real reason that we've gone sideways for the last 6 months is because the AI bubble has attracted a ton of capital into the US. So all the money coming in is because it's all chasing US stocks. And I really truly believe that we are underestimating the amount of like Korean, Japanese retail flow that is occurring and is driving this AI bubble. And I think that's
absolutely. Let me show you a slide real quick that I'll just jump ahead and do. Did you take that out, Rupert? Where is it? Oh, here. This is the long-term, the Schiller Cape or whatever, like the 10-year trailing versus the trade-weighted broad dollar. So not the DXY, which overweights the euro, right? They look pretty similar, don't they? So money flows in the 90s, B's go up because it's mechanical, and then we have an event and the dollar has a little echo boom, which is what my actual dollar long thesis is. Not that we won't have that moment. And then like absolute dump. And so that's kind of like an illustration of exactly what you're saying, I think. Like money from all over the world.
But I would contend that given the amount of money that's coming in and chasing, that the fact that the US dollar's gone sideways is a terrible sign. I think it's showing you that the dollar is actually very weak. And the reality is that if one day when these stocks go down, I think that the US dollar will go down with it, because there's this huge overweight of, investors that own US tech stocks. Because let's face it, nobody buys US for the other stuff. Like nobody's buying US to come invest in their small caps or anything like that. They're buying US to own the Mag 7, because that is what you guys are so great at. That is like the epitome of tech is you go to Silicon Valley and you buy those names, and it's been an absolutely wonderful trade. But imagine it turns.
So here's the way I would say it: the going from that 5.7 million barrels of oil to 14, going from just that weak dollar, and we're all old, so we remember that, till now, and tech was completely cheap back then. We're kind of at max capacity, right? Like if you go back to that chart, it was we're at 38, 40 times Schiller PE. Like we're at the peak. So oil production at the peak, Schiller at the peak. Those are two huge dollar bull situation. So the only thing left would be if assets come down, and debt comes down, you get one last move, and then the actual dollar short. So I'm with you that the post 2000, 2001 trade is upon us. I don't know if it's going to happen right now, maybe, but like I think we're getting close though. And so longer term, I agree with you boys. I just think there's one last, deleveraging moment, I guess, if you will.
Yeah, like you're arguing that so wait, let me understand. So are you arguing that we're going to get a situation where when credit gets destroyed, people rush for US dollars?
So
like
look at this
the
chart,
Brent
right?
Johnson milkshake thing?
So you see the peak in 2000, dollar rallied till about mid 2001. Dollar was sold all the 2000s until rally when the GFC happened. Same kind of thing into 18 and even COVID, right? Like you had that last
you're
21, 22, right? Like 21, dollar had been on its ass the whole year. P's went up and then it ripped. So I'm saying there's one more move in it is what I'm trying to argue basically.
Okay. And listen, I'm not going to deny that. Like it could be, you could be right. I won't say there. I'm not one to sit there and say I can time this squiggle perfectly.
No, I agree.
I just
want you guys to understand where my head was at.
That's fine. I just think the surprises over the next few years will be to the negative for the US dollar. That's my only point.
Where do you think, Kev? Where do you think, our shared view about negative dollar bias, where do you think that is in terms of broader consensus? Right?
Oh, I think it was starting to be put into people's minds, and then ever since the last 6 months, they've forgotten about it again. I don't think anybody's sure.
I'm going to show you something. I'm going to skip to the end. Your friend Andrew Beer, who you've had on the huddle, right? Yeah. Has his CT8 product, which is fantastic, DBMF, but he also has this product called QALT, which is attempts to replicate discretionary macro, right? And it looks at what the indices for discretionary macro are doing, and then his black box reverses out what has caused that move in the index. And what's interesting here is, I've sort of divided up the positions into FX, equities, and rates, right? Yeah. They have, they have broadly got this sort of big euro long, this big Japan short. I mean, kind of neutral overall the dollar, right? So to this point, right? I mean, yeah. the euro long X's out the yen short, but otherwise it's kind of flattish in FX. No strong view on the dollar.
So I agree, and I would say that would be what I'd expect. And the fact that they're short yen doesn't surprise me in the least. And that goes back to my theory that I think it's the Japanese and Korean retail buying US dollars.
And what about the next one? And what about the next one? So they're massively overweight international stocks versus domestic stocks, right? I mean, that reflects my biases for me, right now.
International for you boys. So let's just be clear, all right?
Yeah.
I think that's because they've stopped. Like Rupert, I wrote that piece about when I looked at the fact that everyone was all excited about the U.S. stock market, and everyone's like, "Yeah, you guys told us that it was Sell America. Look at how great we're doing." And I'd be like, "Okay, great. You're right. It's done better than I would have expected." Having said that, when you look on an international basis, actually the U.S. is one of the poorer performing stock markets. And then especially when you look on it a risk-adjusted basis, like I think I did the math, and the Sharp on the MSCI World ex-US index was 3 times that of the S&P 500. And so when you're thinking about a global macro guy that's, putting on trades, it doesn't surprise me that they have that on versus instead of owning S&Ps.
Kevin, I just would warn you, we don't believe in the Sharp ratio here at Betting on the Squirrel. So just so you know that. Upside volatility is not the same as downside volatility.
Yeah, I hear you. I understand. I should have done the other math then, but either way.
But you're right, though. You're absolutely right that like the Greek stock market's up like 60% this year, right? Like, yeah. And I've stubbornly been short Euro Stocks 50, and that has not been a good trade to have on. And so
What,
I just think that
are you just short because you hate socialism? You're just like those socialists. Let me guess, socialists, red tape.
Kevin,
They're
I don't know
never
if you
going to
knew,
make any money.
I lived in Italy and I lived in Lisbon, so I've lived for a long time in Europe. So I have
so that's why you're even more bearish.
How bad they make it for business for people, maybe.
Yeah.
Okay. So
can I just say one thing? What does Jim Grant says? There's no bad bonds. There's just bad prices.
Well, let's get to bonds. Let's get to bonds.
Okay.
So wait. Just let's finish though there, Rupert. The biggest position in this fund is my biggest position also. I just want to
I was about to go there. Yeah. You're
but you have to risk adjust that. That's not fair because they're doing notional. Like
I get
owning 3 month, the March 27.
That is fair. That is fair. That is fair.
Yeah, like that's just not.
I just like that it highlights
yen
it.
Is the biggest
that
position on a risk adjusted basis.
DVO1 position.
Yeah, like I bet you on a true VAR, either the yen or the stock market is the biggest position.
Yeah,
that's like 120.
What I thought was interesting is that they've got this 10/30 steepener on as well, which I've been keeping an eye on all summer.
Don't you feel like that's just his model going a little,
maybe,
too cute?
Maybe I feel like I just like it when smart people agree with me.
Okay, what did you want to go talk about next?
Well, I mean, let's sort of stick with the bonds, right? I mean, because you have been a grizzly Kodiak bear with respect to U.S. Treasuries for a long time.
Yes.
You love your break evens trade. Let's get an update.
I don't feel as great about it. Anyways, go on.
I know. I'm giving you the opportunity. Tell us where you are on the bonds, Kev.
Okay, so you're absolutely correct. I have been like a Kodiak brown, Alaskan, grizzly bear for the longest time. I wrote this thing for Bloomberg in 2022, and I remember saying we could have 2 years in a row of down bond returns, and you should have seen the pedigree of the people who wrote me told me that the bond market's going to teach you, you arrogant SOB for trying to predict 2 years in a row of down bonds. Well, that second year wasn't just down; it was down the worst of probably in a couple of decades. I always joke and say that I'm not. My core is short bonds. And the reason I'm like my core believes that is because I always found it funny that people would tell me that they like bonds, and then they would also tell me how stupid the government was and how awful it was and how poorly managed it was. And I always said, well, you realize inflation is always available. You can always make inflation, and that's what governments will do. So if you're truly actually think the government is as bad as everyone kind of proclaims them to be, you should be short bonds with me. But yet it was always the other way around. So I was short for a long, long time. I guess maybe like 6 months ago, I realized it's not a good trade anymore. I'm like neutral. Like I don't love them. I don't hate them. I think that there's better trades out there in terms of the inflation break evens. I do think that if you made me be long or short over the next decade, it would be a very easy trade. I would choose long inflation break evens. Do I think that the government is going to average more than 2.25% inflation over the next 10 years? Of course I do. Having said that, I don't know. I feel like if we get a risk off event, we could have a deflationary problem, and that we could have these things going back down to levels that people get a little less worried about inflation.
So the squirrel, I don't know if the squirrel told you, I'm a gigantic bond bull. So like I'm in the corner versus you two. You're the dollar bears.
Well, no, because I'm neutral on them. I understand.
Benny, we're just passively aggressively disinterested in the bonds. Okay.
Look, 2017 to 2000 up to COVID, bonds were, honestly, I was short the SOFRs hard, like SFR, or actually we could trade euro dollars back then. It was like these 23 euro dollars. I mean, I sold them at like 99.40 or something. It was insane. Like shorting bonds was the all-time no-brainer in 2020, 2021. So I was with you.
In hindsight, nobody admitted it at the time because I said that and I got yelled at. So I don't buy that it was an all-time no-brainer because I tried to say it and they told me I had no brains. Right? Like, So it wasn't a no-brainer.
I hear you. I have no problem telling everybody they're wrong, and then tell me I'm wrong, and just being like, okay, we'll see.
Yeah.
Like that's not something I ever worry about. But like I will say that was absolutely right. But like, bonds every year you get a little money in. Bonds have been underinvested in from our buddy Mike Green's coming on the show in a month and talking about the passive. So those bonds got re-rated. They weren't getting as many flows. There's more bond TTFs coming in, right? Like, and the truth is, I have a model of every QSUP of treasuries outstanding. There's just not that many long-term bonds. It's like there's $5 trillion, $6 trillion of bonds above seven years of maturity. Like, it's just not that much. You know what I mean?
Yeah.
People think about it like it's this massive market. S&P is like 60 trillion. Like, it dwarfs the long-term bond market. That's all my
Benny, I'm not going to disagree with you. And in fact, if you made me, I could make a bull argument for bonds. Like I'm ready to be convinced. For me, again, I think that ultimately the long-term surprises will be to the positive on inflation over the long run. And I would feel bad, like as a secular bond bear, which is what I am. I just find myself in an environment now where I could make a cyclical argument to own bonds. And I'm like, okay, I'm not going to make that cyclical argument. I'm just going to basically be flat and I'm going to go, do something else.
For sure. And the way I view it is more as a trade. Like, I'm a trader. I trade SOFR. Like, so yes, would I own an asset for 10 years as a bond? I'm not sure that I would for 10 years. Like, I would much rather own gold for 10 years than bonds for 10 years if we're going to play that game. But I guess my point is that the hate from what happened lingers. And I think everyone views the government deficits, they're offended by them. So the bonds are the easiest thing to hate, I think that's the natural mechanics of how people's thinking works.
So I think one of the problems with us is that we go on to Twitter or whatever, or we talk to other people on podcasts, and we think that this is what represents the market. And I think you need to be really careful about that and try to go and talk to like institutions, people that aren't interested in telling you their opinion every second like we are. Like, we're sitting here telling you, I'm going to buy this for this squiggle and stuff like that. And so you get this impression that everyone hates the bond market. Then you go look at the JP Morgan duration survey and they're actually quite long, the institutional money. So I'd be very careful about segmenting your the different cohorts that you're trying to ascribe views to, because I think that you could be correct from a trading perspective that nobody is buying bonds anymore. Like, for the longest time in 2023, there was the folks out there that were buying 1% SOFR calls. Right? Like, they were the people that were expecting a repeat of the global financial crisis, and they were expecting a sharp cut down lower. It's the Caribbean crowd, as Squirrel and I like to call them.
It's the cult of
you said it, not me. So my point is, I will agree with you, Benny, that those guys are gone. And now, not only that, they're screaming about hyperinflation. And so in terms of fading them, I am sympathetic to that. And as the trader in me, that is why, if there was a reason to own bonds, it would be because that crew that was screaming about us going to 1% are now screaming about us going to 7% or 8%. And they're talking about hyperinflation and all this stuff. I could make the argument that inflation is going to go lower over the next 6 months to a year.
I would also make that argument. And I think that it's just, you see how much in the positioning, how many people have steepeners on. The 210 steepener, 110 steepener. There's a lot of guys who are short the 10 and longer, the 530 steepener. Like, so there's a lot of positioning in that, is all I'm trying to say. And so, institutions might own them because if I'm an insurance company or a pension, I need to own some duration assets, right? And, but I'm just telling you, in the derivatives, fast money, leveraged world, the short to long end is the prevalent position, is all.
Yeah, and I won't disagree with you at all.
Yeah.
All right, what else you guys want?
So let's go to what we were talking about, the Mag 7, Kevin. I heard that you have some issues with the Mag 7.
I have lots.
We have a couple charts. Let's bring them up.
Take us through the therapy, Kev.
Ah,
I thought that these two slides were a banger that you put in a note about 3 weeks ago.
yeah.
Probably with an
So
update.
those were the free cash flow of the Mag 7 versus the earnings per share. And if you
Yep.
look, for many years, they just followed each other, almost tick for tick. And the reason was they were asset light, and the reality was that it almost all flowed through to the bottom line. Then what happened was we went into this AI bubble, and what at first, the wise man does, the fool does at the end. And they started increasingly using more and more of their free cash flow for investing in AI infrastructure. And so
this
now
this one just zooms in a bit, right?
yeah, so this is the you can see the ratio of free cash flow to EPS, and you can see the point at which like ChatGPT was announced, and you can see this divergence, right? And so what is that saying? It's we've taken this sector and this industry that used to be asset light and just one of the greatest businesses of all time, and we've gone on this massive spending spree. And not only that, we've gone and put the price of these earnings that we're going to, like what we're going to pay for those earnings to new highs. And I just look at this and it just absolutely, boggles my mind that the world's largest company, trades at 33 times sales, not earnings, sales. Okay, and listen, it's not like I'm an idiot and I don't understand that some companies should trade at 33 times sales. You get some fast-growing young company with lots of room to grow, that's a great purchase. That can very much be the sign of something that's going to explode and be the next, behemoth. But when it's the largest company in the world and you're trading at 33 times sales, let's think back to Scott McNeely's Sun W moment in 2000, and afterwards when they were kind of trying to dissect the bubble and ask him what went wrong, what's the deal, and he said, listen, you guys were trading, you bought us up to 13 times sales. Think about this. If I didn't have any staff, if I didn't cost anything to build my computers, if I didn't have to pay taxes and all these things, it would still take me 13 years to give you back your money. Okay, so this was Scott McNeely talking about 13 times sales being insane. Now we're at 33 times sales. And what's really scary is that it's all in these top 10 stocks, and it's so concentrated. And you go look at these things, these companies regularly have 1/3 to 1/2 corrections. They get down by 33 or 50%. This is standard for these companies. They did it in 2022. We didn't even go into a recession. They just had a little bit of a hiccup, a little scare, and they went down they all got halved. And so what, really makes me just scared is that so many people own the S&P 500 without truly understanding what they own and not realizing that, 40% are in those top 10 names. I think if you go ask your average, go ask your dad or your grandpa, what they own, and they'll say the S&P 500. And most of them will think it's like Warren Buffett told me I should own this. It's a diversified basket of a lot of different American stocks. And they don't realize that it's all one huge bet on AI. And so I think about AI, and I'm fairly confident we're going to have a 1/3 to 50% correction in these things. And to me, the only real question is whether it's going to drag down the entire market or whether we're going to be able to have a rotation and that money will go in and chase other US stocks, and whether it'll cushion it enough so that the index won't get absolutely destroyed. And I'm still open to that idea because I'm actually more excited about regular non-Mag 7 stocks that I've been in a long time. I think that there's a lot of good things happening, and that we could actually small caps. I think small caps could absolutely rip.
Or equal weight, right? I mean,
Yeah.
I was yesterday years old when I found out that Vanguard doesn't offer an equal weighted mutual fund. They're so wedded to the cap weighted index, right? Isn't that incredible?
It's just because they have to scale, right? They don't want to get something that they're going to be constrained by.
Correct.
right? And that's the other thing is that people need to understand is that if you go look at equal weight versus market cap weight over like a long period of time, and if you go look over through history, through all the different markets, on the whole, they crush the market cap. And the reason you might say, well, then if they're so good, why don't people go and invest in them? It's because they can't. Because if everyone did it, we'd have some problems.
It's like Meb Faber's thing. You know, the way to outperform the S&P 500 over time is to never own the largest stock, right?
Is that what he says?
He's back tested that. It's amazing.
But I mean, like, I would say this is that, like, we have a situation where as the share of this dumb money, passive, whatever you want to call it, like the second order weighting differential really drives things. So like I was reading Mike Green, he sent it to me his working paper, and the math is pretty compelling. And here, I'll show you this chart. Let's see what you guys think about this. Share screen, window. Here we go. All right. Can you see that? Or I got to bring the stage here. So this is, look at this. How do you explain this? The weight of the largest 10 stocks versus the weight of the 11 through 50.
Yeah, but isn't that just arguing we're getting more and more narrow? But okay, so here I'll push back on the.
I'm saying that I don't think it's AI. I think that the narrative chases this dynamic to not let people know what the actual mechanics are behind this, and we come up with like stories. Because that's what humans do for thousands of years.
I don't know, because all you have to do is look at the amount of money that's going into AI, into the infrastructure. You just have to look at the debt that they're now taking on. But anyways, listen, let me push back on this idea about this passive idea, because this is a very popular narrative. And if you buy that passive is the reason we're getting more and more concentrated, then you would argue that we should be given that we've never had passive back in the 60s and we never had passive back in the 20s, but yet at those points they also had periods where they were just as concentrated as we are today. So I don't know, like I understand the argument. It's not like I don't understand his argument, but I just think there might be more going on, and it might be more human psychology than you might ever imagine. And combined with some monopoly issues with tech, which is what I think that really also drives it.
So I agree with you. And I have a chart that I don't have, so I can send it to people. But like I have a chart that goes back to the 60s when we had that tech boom with like Rocket, United Technologies, all that stuff in the late 60s, the Nifty 50 and all that. Dollar was strong then. You had a tech boom. Same thing in the 90s, or late 90s, 2000s, and then now. And they were all the most concentrated markets of the last 60, 70 years or whatever.
And
so
the same deal with 29. I think they're just bubbles. Like maybe it's just bubbles. And that's the reality, is that we're in a bubble.
But what I'm trying to say is that this is like an accelerator bubble, because people believe that this mythical S&P return is just so easy to get. You buy the SPY, you get 10%, 20%, whatever. The Qs, like there's something here. And I was on a conversation with a pension, for an asset allocation meeting, and they said they're actually cutting equities because it's too concentrated now, because they're actually buying bonds, to be fair to the bond thing. But
that's the call that should be done, and that's ultimately what you should do. Long-term fiduciaries of money should be doing that. They shouldn't be looking at their benchmark and going, okay, this is my benchmark, therefore I have to own it. They should say, if I was making a portfolio from scratch, would I feel comfortable putting 40% of my money in these top 10 names? Is that really the optimum amount, like optimal, place to put your money? And I would say it's not. And that's not what people should just be blindly doing. And I guess I'm a little bit in Mike's camp in that I think that too many people just accept the benchmark. Right? Like the benchmark is completely an arbitrary thing. Why don't more, long-term pensions go, okay, this is ridiculous. Why am I benched to the S&P 500? I'm going to bench to something broader. I can change it. Those are just choices that we as a society, or we as an investment community, have chosen.
The trouble is you go to ACWI, right? Global stocks. It's not much better, right?
No,
You know,
right. And that is the pushback when people say, "Oh, you're complaining about the U.S. being so concentrated." Go look at other, world markets. Like go look in Korea. Like I don't know how much Samsung is, but I think that the top two names might be 40% there. Like it's even worse. So I get it. I understand. And the other part about this argument about how this is just going to cause a bubble that the passive is never going to be corrected. I'm like, that assumes that nobody goes and just pushes back and says, this doesn't make any sense. Right? Like,
I think it will be corrected. I think it will. I think the buybacks and the passive will be corrected because the buybacks amplify it, right? Like, when you have a mechanical bid, like let's say it's 1% of the volume, it doesn't matter on a day-to-day basis. It doesn't matter in the short term, but over time it compounds and it actually does matter. And that's kind of where like I come out at on this is that like the guys who have the most ability to buy back stock and who then systematically gain the most incremental dollars just have this massive advantage so that you then, like you said, the world's largest company trades at 33 times sales. And the Squirrel will tell you my feelings on that one. Like I push back, and it's not fun to push back against something everybody loves and everybody owns, but it's ridiculous. You're 100% right in calling out. So 100% ridiculous.
But I think that what really is going to happen is you said you just had this pension fund meeting and they're changing their allocation, and that's really what should be done, right? And like I assume that we have some retail or people who manage their own money here. I think that retail is at a huge advantage in this market because the reality is that they don't have to play. They can say, I'm going to sit this out because the reality is, yes, maybe it'll keep going. Maybe I'll miss the next quarter or the next 2 quarters, maybe a whole year I'll miss. But I know that over the longer term that this is a bad point to be investing large sums of money in the index. And so they're able to sit it out. Whereas if you're sitting there and you're managing money on an institutional basis, you don't have that luxury. You miss a quarter, you miss 2 quarters, you're gone. So it's this thing that they're all chasing this benchmark. And Mike is correct in that fashion that as more money comes into the market, they have to just keep chasing this benchmark. But ultimately, the adults in the room should say, listen, this is a bad system and we have to change this. And we need to, think about our benchmarks.
So I hear you, but as a guy who earned his spurs right before the GFC and like saw the system was broken then, and we've been on life support for some time now of the government's vol suppression, state-sponsored expansion of balance sheets, etc. Like, it's a lot easier said than done to be on the other side of a secular trade because you know what? Rupert's going to pull his money eventually on me, and I'm going to be like, well, like the old gold bugs, right? The old gold bugs, like now they're having their day in the sun right now, right? But forever,
not going to make that much difference.
But Benny, I'm not like a long-term bear. Like don't put me in the Hussman camp. Like I was bullish in 2023 and 2024. Like consistently and pushing back when everyone was super bearish on the economy. I kept saying, no, listen, there's so much fiscal in the pike, it's coming. You guys are so bearish. And I think that it's kind of funny now because we're in this environment where I remember I had this event. It was a market huddle event, and my buddy Harris Kupperman came to Toronto, and we had 20 people come to the bar with us, and we chose them. They had to sing for their supper. They had to come up with an idea and present to everyone. Well, so Cuppy and I present, and we were both like, it's 2023. We're both bullish. We're both presenting bull ideas, right? The next 20, all bearish. Afterwards, everyone comes and talks to me and says, you guys are really nice guys, but you just don't understand how bad the economy is. You just don't get it. And they just get it. 23. Because it was after 2022 and it was things looked bad. They raised rates, and everyone thought that there was the highest percentage of professional forecasters that expected a recession in the next year in the history of this 50-year table. Or series data that they had. That's how bearish everyone was. It was off the charts bearish. And so now I contrast that. So that was the point where I was bullish. I was pushing back against the narrative that, things were as bad as everyone thinks. Now at 23 times next year's earnings, okay, everyone is all of a sudden bullish and just telling me, no, you don't understand. The government won't let stocks go down. And I'm like, first of all, when did the government get so powerful that they're not going to let stocks go down? And do you not understand how risky that concentration bet is up there? And that's what really scares me, is that I think that there's a confidence that is scary, right? Like, you buy your straw hats in the winter, right? Like, you buy them when no one else wants to buy the insurance. And one of the things, like, I remember in 2023, everyone said to me, do you think we're going to crash? And I said, no, we're not going to crash. And you go, why not? I go, because you're asking me if we're going to crash. Like, the reality is we don't crash when everyone thinks we're going to crash. We crash when when people aren't expecting it. When that's what causes the confidence that then creates the conditions that cause the crash. And so it's hard, and it's difficult to be in the minority. And you do look like a fool for a quarter or maybe a half year. But the reality is, I go back to those retail. That's why they're at a huge advantage. They don't have the pressure of getting fired. So they can just go, I'm not playing at 23 times next 12 months earnings, or I'm going to go hide in something that's a little, more reasonable.
Well, check this out, Kev, because I'm totally with you. People didn't realize that in 22 we were doing a 10% nominal GDP. I was born in 1982. I didn't even know that was a real thing. I would see history books. I didn't know we could actually do 10% nominal GDP. And I know Trump was questioning today, why can't we do 25? Which shows his economic acumen.
25. What if he's right and we're going to do 25 because we got so much inflation?
Line is the S&P trailing PE, and the white line is year-over-year GDP. So if the S&P is like 18 times and the GDP is at 10 times, and everyone's bearish, it's like, well, what are you doing? You know what I mean? Like, you're just
that's where we were.
Proving that you're a momentum player, that everybody's been turned into, things are price feedback loop is negative, so then I'm negative. Price feedback. Now look, now we're at 28 times trailing earnings, the S&P, and
everyone loves
GDP
it.
is going like this,
and everyone loves it.
Guys, that we just don't have to be there. We're retail investors. At the end of the
that's
day.
the key.
We don't have to be. I think that's a perfect place to leave it. Kev, everyone can find you at themacrotourist.com. Any other
send me an email. If anyone wants to get a recent letter, send me an email, Kevin at themacrotourist.com. And thank you very much for having me on, guys. It's always a fun, spirited chatting with you guys.
Yeah, that was fun. Thank you, buddy.
Completely our pleasure, Kev. Thank you. All right, guys. Take care.
Kev,